Hey investor friends, I'm Michelle Markey, and may the force be with you on this day of May 4, where I encourage everyone to be the best investor they can be, especially women. And this is part of a recurring theme I like to call Mind the Investing and Wage Gap and the Rise of Women Investors, because Danielle Town primarily wrote the book Invested with input from her father, where I'll be covering the May chapter on Charlie's moat and management principles. And when I say Charlie, I'm referring to Charlie Munger, one of the legendary goats of investing. And this chapter covers 2 out of 4 of Charlie's investing principles, 2 of which are first, the moat or intrinsic and durable competitive advantage, and second being management with integrity and talent, ideally. And while these principles might seem simple, they're loaded with meaning. And you know what also is loaded with meaning is if you wouldn't mind smashing that like button for the YouTube algorithm, because it greatly helps out my channel, and I'd love if you could please subscribe. Thanks. The concept of moat is part of the Warren Buffett investing strategy, where you can think of it exactly like the medieval moat, where a body of water surrounds a castle. And it's a similar concept that applies to business. And what this means is you have a uniquely protective competitive advantage where the intrinsic part of it can't be separated from the business. So it's intrinsic to the business itself. And what makes it durable is that it would be so difficult or expensive for someone else to compete with that moat of this company that they either wouldn't be as good at it or they would just fail. And the first moat out of 5.5 that Phil and Danielle talk about would be a brand moat. And I tend to think of Ziploc bags. And when I think of a bag that zips, I don't think of anything else but calling it Ziploc. So this has a strong brand moat. And then the second being a switching moat, where Apple Computer tends to have a great switching moat where if you're part of the Apple ecosystem, you don't really want to switch to something like using Android. And even though I still use Windows, I can see why a lot of people never go outside the Apple ecosystem. And the 2.5 one is network effects. So it's part of being part of an exclusive thing that a lot of people want to be part of, such as YouTube. So being a YouTube creator is a special kind of network, as well as Instagram. And the third kind of moat is a toll bridge. So if you need to go to one destination that's separated by an actual physical bridge, you got to pay the toll to cross it. And this applies to business products as well, where you have a niche product that has a near monopoly in a big industry. And then number 4, secrets moat, where companies can choose to file patents for their special formulas, or in the case of 3M, they might just keep their trade secrets of how to make Scotch tape. And I actually think Scotch is a brand name too. And number 5 is a price moat, where companies like Costco are able to be the low-cost provider of the goods and services it provides, and others have trouble competing with Costco. So those were the 5 moats, and they were real quick: brand, switching, network effects, toll bridge, secrets, and price. Next, the financial statements of public companies as required by the Securities and Exchange Commission can give us quantitative insights into the performance of companies over time to measure how durable their competitive advantages really are. And for this, Phil tells us to look at 3 kinds of statements, and they include the income statement, or also known as profit and loss statement, where you keep track of your sales or revenues as well as your expenses, and this forms whether you have a profit or a loss at the end of a fiscal year. And then we have the balance sheet, which summarizes what you own, or also known as your assets, and what you owe, or also known as your liabilities. So often when you subtract liabilities from assets, you get your equity. And then we have the cash flow statement, which is the amount of cash you have in the bank. And this is the operating cash that results from business activities. Phil calls the moat numbers the big 4 numbers, and they include number 1, net income, which is also known as net earnings or net profit. And you get this after all the costs that went into making a profit. And this is from the income statement. And then number 2 is book value, which is equity. And you get equity from subtracting total liabilities from total assets. And then you add to equity dividends, which you will find from the cash flow statement. And then number 3 is sales, or this is also known as revenue, and you find this from the income statement. And then number 4 is operating cash, which is also from the cash flow statement. And I hope those are pretty self-explanatory. Phil tells Danielle that you typically want to see these numbers growing at 10% or more per year. And the other thing to keep in mind is he says choose one overall growth rate for the company. And Danielle asked if that's just averaging all the big 4 numbers, to which he emphatically said no. It's to take the windage growth rate. And they use another analogy, but I'm going to use this one. Imagine if you have a bow and arrow and you're aiming for a target and you need to take the wind into account. So if you have wind affecting your arrow's trajectory, you're going to make an estimation of how you're going to shoot the arrow so that it lands where you expect it to land. And so in the example in the book, Danielle chooses an overall growth rate for something like Apple to be 8%. In the next principle, Charlie Munger says how he would like to have management with integrity and talent. Emphasis on the like, as Phil points out to Danielle, because like the Warren Buffett quote goes, invest in a business any fool can run, because someday a fool will run it. And this goes to show that we should invest in businesses that are doing so well that an idiot could run it. And we should prepare for this eventuality, because sometimes the original founders may not be with the companies anymore, and you might not know how to really judge a management team, especially the chief executive officer. So it's important to try to evaluate as many factors as possible to see if a management team can be trustworthy and that you believe they can do a good job in running the company. And Danielle talks about how when she was a startup lawyer, she learned that it's kind of like learning how to date, and you get to know company CEOs from startups that way, but it's often more difficult to get to know public company CEOs. So the next best thing we have is to be able to look at their annual letters from the 10K annual reports from the companies. And if we're able to measure if we think that they have candor and if they're mission or community oriented, we can try to get a feel for how does the CEO really behave. And what Danielle has also done is she's put together a little bio of a company CEO and get to know them and what type of manager they are and how they get along with the board of directors, and also if they have a significant stake invested in the company. So this isn't just whether they've gotten a lot of stock options, it's how much actual shares they own in the company to see if they believe in it. And there's a difference between measuring if they're just selling some of their stock options as part of their salary, or if they're really dumping a lot. And we can see this as part of some insider trading resources online. Danielle also brings up this hedge fund manager named Matthew Peterson, who shares an especially cool insight about how to judge the vocabulary used in public statements by CEOs. And it goes like this. When management is talking in terms of per share growth and free cash flow and internal rates of return, it is a signal that they share a value investing mindset and consider things through a capital allocation lens. And I find this to be very cool to think about how a CEO communicates with their shareholders and other stakeholders. Since I've been a shareholder of Starbucks for a long time, I'll use that as an example to judge the quantitative and qualitative factors associated with these two principles. And when it comes to judging management, in the case where Danielle talked about if a CEO is literally invested in the company's long-term success, I want to look at the CEO, Kevin Johnson's investments in Starbucks. And I can see from looking at websites like Dataroma, what insider transactions he's had, and he had a lot at the beginning of April where he sold over 300,000 shares. And then apparently he still has over 500,000 shares left over. So I'm not really sure if he's just trying to take advantage of high prices, because he also went on CNBC at the end of 2020 saying how he thinks that Starbucks will rebound in 2021. So it's sort of confusing how much Kevin is selling his shares, because I don't really know what to make of the fact that he's been selling a lot of his shares lately. And then other things I would look at include his CEO messages, and I find it curious that Starbucks is stylizing CEO all in lowercase, and he seems to be mission oriented. And he came aboard in April 2017 after Howard Schultz had left from being at the helm from 2008 to 2017. And before that, he ran the company from 1986 to 2000. And I consider Howard Schultz to be the OG founder, and unfortunately he's not around. So we got to figure out if this Kevin guy is a good long-term CEO for Starbucks or not. And I'll get into a little bit more of the quantitative measures about Kevin's performance so far shortly. And to judge the management by the cold, hard numbers, I suggest going to the SEC Edgar site to search for the official 10K annual reports from public companies, or you can also go to the investor relations websites of the public companies. So in the case of Starbucks, for what I couldn't get out of the SEC website, I went directly to Starbucks' website to find the historical annual report so I could calculate these numbers. Sometimes some other sites also try to accumulate this data, but since I don't always know how they're deriving some of their final numbers, I don't fully trust how they're doing their calculations, so I'd rather do my own. So when I gathered all these documents, I busted out a spreadsheet and did some calculations. But before that, I need to explain a couple of things that Phil says that we use to judge the management. There are three main numbers that we use, and they are return on equity, return on invested capital, and debt. And the first one, return on equity, is measured by taking the net income and dividing over the equity, and that's expressed as a percentage. And then we have number two, return on invested capital, or Roik, and that's where you take net income divided by your equity plus debt. So that gets you a little bit of a smaller number than what you would have with return on equity, which Phil says can be financially engineered because it's not taking into account the amount of debt that someone might have used to try to get the net profits. With number three, debt, Phil says ideally we want that to be zero, but if they have some long-term debt that can be paid off with a year or two of earnings, then that's okay. But ideally, it's better to not have any at all. And as a quick example, Danielle talks about an imaginary lemonade stand business where, let's say you have $1,000 in equity, $1,000 in debt, and you made $100 on both of those factors. So when you divide 100 into 1,000, you get 10% for the ROE. Whereas if you divide 100 into 1,000 plus 1,000 or 2,000, you get 5%, which is the Roik. So that's an easy way to think of calculating ROE and Roik. Since Phil said we want to have a company that has an ROE and Roik of 15% or better, I wanted to check how Starbucks has done lately because it's been a while since I really dug deep into the numbers. So I gathered the last 15 years worth of annual reports and looked into each of the main types of statement numbers. And as a snapshot, they included information from the cash statement, the income statement, and the balance sheet. As you see here, things have been trending down a little bit in the last few years, with cash from operating activities down in 2019 and 2020, and net earnings also down in the last couple of years. But of course, last year, 2020, was the main chunk of the coronavirus pandemic, so that's understandable. And the total assets seem to go up in 2020, but on the downside, the liabilities also went up. So that's not a great sign for Starbucks to have these negative kinds of numbers in this high-level snapshot of what's going on in their financial statements. And then moving on to a spreadsheet I created of Starbucks's last 15 years worth of numbers, I can see here that their net income had risen to an all-time high back in 2018 after Kevin had been at the helm for a year and a half. And then their total assets also seem to reach a pretty good number, but their liabilities reached more than double what it was the year before, and that's pretty gnarly. And then we can see that although they had pretty decent numbers leading up to 2018, it all seemed to start going into the negative in 2019 and 2020. So that's a little bit concerning to me, because while their return on equity averaged 24.73% over the last 15 years from 2006 through 2020, and for the 10-year average from 2011 to 2020 averaged 26.62, if we actually look at their Roik instead, we can see that's a difference of 16 and 17% respectively, where the 15-year average Roik was 8.71%, while the 10-year average Roik was 9.54%. So based on looking at these values, I'm a little bit worried that Starbucks is not hitting the mark as far as what we as Charlie Munger and Warren Buffett style investors expect, and definitely not hitting the 15% that we would like to see for both ROIC and ROE. So all in all, currently with Starbucks performing the way it is right now, and it having recently hit a PE ratio of over 200, I think that it's a little bit too pricey to buy right now, but I wouldn't sell the stock I still own, and I'd wait until an opportunity to buy Starbucks on sale. And also at the end of this chapter, Danielle mentions how she put together a checklist, which is pretty great. It summarizes a lot of the key questions that she and her father discussed in this chapter. And I encourage you to check it out and buy the book or borrow the book from your local library, because it's a great resource and it can help you formulate your own checklist of key management and moat questions to ask. And if you enjoyed this video or learned something, please like and subscribe, and may the odds be ever in your investing favor. Till next time.